Hello, everyone. Welcome to Calling All Real Estate Investors. We are here every Tuesday from 1:30 p.m. or 4:30 p.m. Eastern Standard Time. Today, Caeli is going to be going over recourse versus non-recourse loans. And I think we're going to have a little surprise sprinkled in there as well. So stay tuned for that. And thank you so much for being here. If you have any questions throughout this call, please go ahead and drop those in the chat and we will get them answered as soon as possible. So yes, we love your participation. Anything, all questions, please put those in the chat. And then I'm going to hand it off to Caeli. Thank you so much.
Thank you, Ms. Carly. Hi, guys. As always, thanks for being here with me. So I was thinking about this today, and I want to just take a minute and kind of have an open forum for anybody that wants to participate. This is totally unrelated to mortgage or to real estate investing, but this is a nice platform in which I can ask some questions about some things that I'm observing, and I'm just interested in some opinions just from colleagues, people in a space that I occupy. So I hope you'll forgive me again, totally unrelated to anything that we would be otherwise talking about. There's a few things. Has anybody noticed, and this is going to be a little bit of a dig at Gen Z. So anybody that's in that age group, I don't think there's probably too many of you, but any of you that in that age group, my apologies in advance. This is not meant to be offensive. I have two of my own that I've just recently, launched both. They're both now out of my house. And I actually, Lisa, I was talking to you a little bit about this a couple of weeks ago. First of all, the language barrier. I think there is an epidemic going on right now with the word like. Has anybody else noticed that the word like as a use, a place filler for conversation because they don't maybe have they don't have the words to use? Last night, I was out to dinner with my husband, and we were sitting next to a group of girls. And I was overcome by, I could not believe how many likes. And I started to count, and it was just such a ridiculous thing. Is anybody getting this or picking up on how often that word in conversation is used inappropriately? They're not saying I like ice cream or anything like that. Anybody? I mean, anybody getting a feel for that at all? Because I think it's such a drastic difference to how people are communicating, and it's not good. It is not good. If I had an interview with any one of those girls, I mean, I would be done inside 5 minutes, and I would never ever. How are they going to be employed? I mean, how are they going to survive and talk that way? Does anybody seeing this? Is it just all on me? That's the first part. And Carly, is there any way that we can just get rid of they have to ask to unmute?
Yeah, no, definitely. I can get rid of that. We do have a couple of comments though. Walt says he hears a lot of like and sweet uses filler words, and Charles says all the time he hears this. Lisa says Valley Girls always said like, whatever.
But it feels like it's almost every other word.
Yeah, Teresa said it's overused. And Lisa actually says she doesn't feel like this is a new phenomenon. So I actually agree with you, Lisa. I feel like it's been going on for a while.
I think it's just gotten so bad. I know that in our house, because yes, I have heard it. My kids are now both in college. But in our house, when their friends would come over, it didn't matter who it was, they would be doing push-ups or putting a quarter in the jar if they used it in inappropriate ways. So we tried to curb that at a very early age when I started to hear it, but I just think it's out of control now. The second thing is, and then I'll get off this and I'll move on to what you guys are here for. I'm very interested to get some feedback, because I'm, guys, I live in kind of a box. I'm singularly focused in the space that I'm in, and I don't get out much. So I'm really curious if you guys are seeing this out there in the service industries, especially. There isn't anybody that is mentoring this generation from a workforce perspective. And I'm finding that, wherever it is, whatever it is, when you need to be, you're being served in a restaurant or on the phone, or it doesn't even matter. But there has to be some customer service involved. that they just are clueless, and I can feel that they feel it. They feel that I feel it, and they just don't. The training isn't there, and I'm really trying to impart to my kids that necessity is the mother of all invention, right? Somebody needs to step up and help take control, especially on a corporate level, and provide some kind of mentorship or training for this young Gen Z, because I feel like they don't have that. Is it just me? Is anybody else feeling that when they go out and about in the world?
I'm really fortunate that I have a 20-year-old and a 16 and 15-year-old, and they're both really industrious, hard workers. My 20-year-old, where she just went into Michael Kors, and simply because she's bright and aware and can connect with people, the manager came up and said, "Can I hire you?" Gonna give her attire and a commission on top of great pay. And she has those experiences, she says, everywhere she goes. And what I can tell you is she's just simply a present young person. And I do think that they're rare, from what I can tell. And when she went to a very expensive school for a year, which she didn't quite fit culturally, everybody was like. Now she goes to community college and holds down 3 different jobs, and is, loves it, because she says she's around a diverse group of people, meaning not just her age and people who are more interesting. So I'm glad. I do think it's sad that, but I also think it might have to do with maybe the lack of engagement of conversation with people outside of their own age group.
I think that's exactly right. With phones and social media and the abbreviation of text and everything, I think that's true. Thank you, Jamal, for that input. I really appreciate it. I think that it is the exception, and I think the younger generation is going to get stuck. And I hope somebody, maybe one of my kids, with my harping on them, can come up with some solutions to help bridge some gap. Anyway, okay. Sorry. Okay, I know that was so random, but you guys are the only people that I really get to talk to collectively, and I can't really have this as a one-on-one conversation with our clients during the day. They'll think I'm crazy. So you guys get to think I'm crazy. Okay, let's get on with what we're here to talk about. Last week I had said we're going to talk about amortization versus interest only. I have yet to become prepared for that for you, so I changed the topic, and we're going to talk about recourse versus non-recourse. I had asked some people in the office what questions they were getting, and that one's coming up a lot. So just to quickly go over some of those differences and why it's important to know the differences, then I'll get into my surprise. I think if you read the headline, I've got something exciting to share that we will finish the half hour with. Recourse versus non-recourse. So the difference is very simply whether or not you're obligated to the debt, individually obligated to the debt. And where it can be most important is when we're talking about those golden tickets, the Fannie Freddies. For those of you that are not aware, we call Fannie Mae, Freddie Mac, conventional agency conforming loans, whatever you want to call it, the golden tickets, because these are going to give you the highest leverage at the lowest interest rates on the planet. And the guidelines for that say that you cannot have more than 10 financed properties per qualified individual. Okay, that's what Fannie and Freddie say. So the definition of what counts against those 10 are as follows, and this is where people get tripped up a little bit. So first of all, it's residential only, single family up to 4 unit. If it's a commercial property, 5 unit, or a retail space or a strip mall or whatever, does not apply. This is only applicable to residential property. 1 to 4 unit condo obviously applies. And the rule is as follows. It's any residential property that is leveraged, that is a loan on it in your individual name or personally guaranteed by you. Very commonly, almost daily, people think that the loan that they secured in their LLC name a year or 2 or 5 or 10 years ago, where both the loan and title close in the LLC name, would not count against the Fannie Freddie 10. Well, that is not true if there was a personal guarantee associated with that commercial loan. If there was a personal guarantee, and we would find this via the note that you signed at closing, then that absolutely will count against the Fannie Freddie 10. Okay, so very, very important distinction. Those people that have 30 properties that are all mortgaged, and they think that they have all their golden tickets left because they were all secured by using an LLC, but come to find out they all have personal guarantees. Those people cannot get or are not eligible for those Fannie Freddie. They'd have to refinance those commercial loans into what's called a non-recourse, where both the loan and title close in the entity name, but there is no personal guarantee. Okay. Now let's talk about kind of the differences between those two things. You know, I was emailing a client earlier, and this topic had come up. He was saying he didn't want to have the loans show up on his credit report, and I wanted to dig a little bit further and kind of understand why. What was the method of his need for this? And if it's exclusively asset protection, you guys, then I would tell you that having it on your credit report or not probably isn't that big of a deal. I'll come back to that. Let me finish my thought on recourse versus non-recourse. The circumstances when I think non-recourse is appropriate or applicable is really going to be for those multi-million-dollar transaction types. You know, 100-unit apartment complex or 500-unit apartment complex. That's when a non-recourse loan, I think, is going to be most appropriate. Let's go back to recourse and what that really means. If you've signed a personal guarantee, that means that in the event of default, technically, the lending entity or the servicer can come back and attach assets for their losses, right? That is true, and it is written in your loan documents that way. However, I would share with you guys that in the 25 years that I have been doing this, in the event of default, which is pretty rare, but let's just say that you did default on the loan, the amount of times that I have seen a lender go back and attach the individual it would be I think I've even only heard of it one time. And that one time exception was because the property was in such disrepair. I mean, just completely gutted and totally tore up. That was a circumstance that I had heard of. I wasn't even involved in the scenario where the lending entity went after the individual. Otherwise, my point here is they just want the property back, right? They're not going to, they just want to get their property back as quickly as possible in the event of default, get it ready and resell it. Okay, attaching you and your assets, even on a recourse loan, I suspect would be an extremely, extremely rare proposition. So why is this piece of intel important? The difference in rates and terms between recourse and non-recourse are pretty substantial. If you truly believe you need a non-recourse loan, okay, there's no personal guarantee, it is in the entity name only, that's fine, but then you need to be prepared for a balloon feature, right? Where at the end of 5 years or 10 years or something, the note is due. Or maybe it's an adjustable rate mortgage. Extremely harsh prepayment penalties on a non-recourse loan, and the interest rates are going to be, you know, upwards of 2% plus higher than anything else that you're going to get. So keep in mind that if in deciding between recourse and non-recourse, you're dead set on that non-recourse, what does it actually mean for the bottom line of the investment? And what are you really getting out of that? Okay, any comments, questions about any of that, guys? Anybody? Recourse, non-recourse, how it applies to the Fannie Freddie golden tickets. General rule of thumb, the further away you get from skin in the game, the higher the rate and the less attractive the terms are going to be. And that would be applicable to non-recourse. If you look at the spectrum, for, you know, best rates and terms on investment real estate, and then the worst, a non-recourse is going to be the highest rate and the least attractive terms.
So we do
Go
have a
ahead, Carly.
question here from Walt. He asks, does a DSCR loan fall under non-recourse?
It could, sure, Walt, but more often than not, debt service coverage ratio loans, most of the loans that you guys are going to be looking at, I'd say the vast majority are going to be recourse, whether it's debt service coverage ratio or it's a full income documentation. If it's written to the entity name, if the loan is written to your LLC name and you're closing title in the LLC, most of those are going to be recourse anyway. Most of them come with a personal guarantee. And certainly, yes, the debt service coverage ratio can fall under that, but non-recourse certainly can apply to debt service and completely without the personal guarantee to the entity. Anybody else? Anything? Recourse, non-recourse? So I guess just to summarize what I would say about this, I don't see a place for non-recourse unless it's very, very specific set of circumstances that actually benefits you. I think you're going to be better served with if you want the loan in the entity name. If even that is super important to you, fine, sign the personal guarantee. Get the significantly better terms, because at the end of the day, in the event of default, they really just want the property back. Okay. I'm going to preface by saying I'm not an attorney and I'm not giving anybody here legal advice. To be clear, there's that. And just to go backwards real quickly, if you have golden tickets and your intention for having the properties, holding the properties in the LLC name, if it's exclusively for asset protection, there's no reason that you should not secure, and you can qualify. There's no reason that you shouldn't secure those Fannie Freddie loans and maximize those golden tickets. Because if the need for the entity is exclusively asset protection, you can simply execute the quit claim deed, QUIT, quit claim deed, sometimes it's called a warranty deed, after closing into the LLC name without that due on sale clause. That is old thinking, old philosophy. Due on sale clause does not apply to Fannie Freddie any longer, as long as you, the one obligated to the debt, has the majority ownership in the LLC.
We do
Okay.
have a question here from Armando. He asks, will we talk about options once we've exhausted our 10 golden tickets or 20 golden tickets if they're married?
Yes. Thank you, Armando, for the question. So kind of looking at it from the lens that we want to maintain, when we go from the Fannie Freddies, which we've already determined, golden tickets, right? Those are going to be your best options for terms and rates, et cetera. The next step is going to be on the non-QM. Non-QM, QM stands for qualified mortgage. Fannie Mae, Freddie Mac are the epitome. The definition of what a qualified mortgage is Fannie Mae, Freddie Mac. Okay, they have that 10 max requirement. Now we're going to move into non-QM. Non-QM has debt service coverage ratio, bank statement loans, asset depletion loans, but it also can keep going full doc, right? Remember I said just a second ago, the more skin in the game you have, the better the terms are. So if you've already maxed out your golden tickets and you just want to continue down that lane or that path, you're going to go into non-QM and you're still going to supply all of your income documentation, et cetera. Okay. You're going to close the loan in your individual name. These loans will allow you to close title in the LLC name. So Fannie Freddie, both the loan and title close at closing in the individual name. You would quit claim into the entity name after closing Fannie Freddie. Non-QM, most of the time is going to close in your individual name. Not always, but most of the time will close in your individual name. And title can close in the entity name. You don't have to do the quit claim deed. Okay, best rates and terms past the Fannie Freddie 10 are going to be non-QM full income documentation. There is no longer a restriction to how many finance properties you can have in non-QM, but it's not federally guaranteed. You don't have the United States government guaranteeing that mortgage-backed security against default, right? It's a separate set of investors, so the interest rate's going to be a little bit higher. But that would be your next best. So from Fannie Freddie, full doc non-QM, closing the entity in the title in the entity name, loan is still in your name. But even if we go outside of that, outside of the non-QM, we have products that will allow you to close the loan and title in the LLC name, but that is one tier or one step further from the rates and terms on the non-QM full doc, right? You guys following me? So if you think about a spectrum, and the further away you get from full income documentation, vials of blood and DNA samples, and the entity name, and a personal guarantee, and not a personal guarantee, the further away from that we get, the less attractive the terms are going to be. And we have all of it. It's really going to be specific to your own set of circumstances, where you are right now, where you want to go next year, et cetera. That'll help us decide which one of those buckets you're going to be focused on at any point in time. Thank you for the question. Anything else, Carly?
Yeah, another from Armando. He asked, will we still be required to show income and expenses on all properties, mortgage statements, lease agreements, et cetera?
Only if you want the best terms in that non-QM space, but no. So non-QM, again, just by itself as a product line, has lots of different individual loan programs inside non-QM. So the best of those are going to be that you would supply all of those documents, right? Just like you would Fannie Freddie. If you didn't want to do that inside non-QM as well, we've got debt service coverage ratios that say no income documentation is going to be required. It's really more about your assets. You have your cash to close and your credit score, right? Credit score will ultimately determine largely what kind of interest rate you're going to get. The debt service of the property plays a big role there too. But I think that answers your question, Armando. If not, please type in another one.
Let's see. So we have a question from Lisa. She has a quick question on what you were just talking about, because she was told that she had to close in her personal name and then quit claim to her trust for a non-QM. And is that correct?
Depending on the product that we're talking about, it could be, but there are products as well that you can close in the entity name at closing. So the terms might change, Lise, but yes, you could do that. So I think looking at them side by side and seeing what is your preference. So if it means you've got, yeah,
it might be the product that I have then, because she said I could do it like part of the same closing, but then it had to originate in my personal name, and then I could quit claim it to the trust. But I can't do it. I can't close in the trust.
Okay.
It might be the
I will
product. I
check.
can email you. I can email you.
It definitely could be, but
Okay.
let's make sure that we're distinguishing between the loan is probably closing in your name, and title at closing when you're signing your loan documents can be titled in the entity name or the trust name.
Correct. That's what. Yeah, I'm talking about title. I'm sorry.
Yeah. Okay. So that's, yes, then that's absolutely the product. And I'm going to recommend that's probably what you want to do, because remember, so maybe I'm not explaining this in the best way possible. So let's take Lisa's example. Okay. She is closing on a product where the loan is going to be in her individual name, Lisa Brubaker. Okay. This is a non-QM product that will allow her at closing for the title to close in the entity name. So loan is in her individual name. Title, when she's signing her documents, will be in the name of the entity. That is going to be better terms than if we were to find a loan that is going to close the loan in the entity name and title in the entity name, but chances are that product is going to sign a personal guarantee anyway. So you personally would be on the hook anyway. So the difference between that and what we're structuring over here, where the loan is in your individual name, is pretty much zero. I think the one difference would be is that the one that's going to close in your individual name will show up on your credit report. But who cares? What difference does that make? And if it's for asset protection, if the entity is for asset protection, anybody that is going to the trouble to sue you wouldn't have access to see your credit anyway. They'd never have access. They wouldn't know what was on there. They're going to be doing title searches to find out what assets are in your individual name. Did I answer your question, Lise?
Yeah, I'm going to email her because she specifically said that I had to arrange for the quick claim. She specifically said that I had to quit claim it, that we had to close in my name. But I don't know what we could be talking about, different products, and I don't want to hijack
Okay,
your
let's look
call.
at it. Okay, that's okay. We'll look at it. We'll look at it. Okay.
Okay.
It's
Perfect.
also
Thanks,
not
Lisa.
urgent. It's also not urgent either.
Okay.
So
All right. Well, we'll take a peek.
Thank
What
you.
else,
And
Carly?
we have another, we have a question here from Chris. Can you generalize on the spread of rates between the range of products, QM to non-QM to DSCR products?
Thank you, Chris. This is a very good question, and I'm afraid that the answer is going to be a little bit convoluted, because within each of those answers are 20 different variables that could change the range. So I'll do my best. Actually, let me start this way. The lowest possible rate I think you're going to find for an investment property, and remember you guys, the variables of the transaction greatly dictate the rate, regardless of product, right? Loan to value, loan size, property type, purchase versus refi, credit score, all of those things have very specific changes to the interest rate. So I'm going to go lowest possible interest rate, and I'll take it up to feasibly maybe the highest, and then I'll try to break it down in between. So right now, the best possible scenario rate, I would say that you maybe would get into the low sixes, maybe the high fives, but you are leveraging maybe 50%. You are completely full doc. It could be, there's probably a buy down of the rate associated with that in that kind of rate range. That's your best case scenario. And it's almost certainly a conventional product, or maybe it's a credit union product. Worst case scenario, institutionally speaking, for investment, residential investment, and I'm not talking bridge loan because that would add a whole nother layer. We're talking about more of a long-term, 5-year ARM, 5-year fixed to 30-year fixed. You're probably 10, 11%, right? That's going to be the range between maybe the best and the highest. And then in between, when we talk about the full doc and the debt service coverage ratio, non-QM, QM, recourse, non-recourse, right? It starts to get real convoluted. Add anywhere from a point to 2 points in each one of those buckets. Chris, if you want, we can have a quick one-on-one call, and I can layer that out a little bit easier or more directly if we have a scenario that we can work from. Let's say that we take one particular purchase at these different variables, and then I can say, okay, if it was in this bucket, this would be the approximate rate, and then we can kind of go up from there and be more specific if that's helpful. Just ping me, Chris, okay? Anything else, Carly?
That'd be great, thanks.
Yeah, you bet.
That's all questions for now. I think.
Okay.
Yeah.
The surprise with a few minutes to spare. Okay. So I have been working tirelessly to try to expand the products that we have offering for our investors. And while it's already fairly diverse, I think, I am very pleased to announce that finally, this has been on my radar for many, many years. We now have ground up construction. Let the trumpets blare. This has been largely missing for several years. We used to do a fair amount of it way back in the day after the crash, not so much, and then it just went away. I mean, legitimately gone, especially for rental properties. They started to bring it back a little bit for primary residence. So I'm very pleased to say that ground up construction, for those of you that are interested in that, is back on tap. It's extremely brand new. We have not even closed on one of these yet. We haven't even started marketing to it, but I'm going to share my screen and just kind of go over a few of the details and bullet points that will be associated with this. What did I do with it? Hold on, gang. Let's see if I can figure this out. Where did you go? Share screen. And there it is. Okay, so I had Carly throw this together just before our call. So this is just a very quick overview of what you can expect. Carly, if you want, just real quickly on the side, anybody, maybe take a poll of anybody that is interested in, has been, is, or maybe will be interested in ground up construction, just to get a feel for whoever's on this call that might be in need of more information. So ground up construction, you guys can see these bullets. We'll put it on the community site too, so you can grab at this. Pretty self-explanatory. I won't spend a ton of time on this. 12 to 18-month terms. There's always room for extensions if you needed it. If the construction was delayed for whatever reason, there'll be a cost almost always to extend. Up to 75% loan to cost. Okay, so for those of you that don't know what that is, you're going to take the purchase of the property and the cost of construction, add those together with the ARV, and then 75% is going to be the cap there. 100% controlled construction budget. This means that it's going to be whether it's owner builder or it's a general contractor, et cetera, it's going to be extremely scrutinized. We're going to make sure we're going to have people on site, making sure that the completion is done to satisfaction before draws will be released or issued. Obviously, no income documentation is necessary on this. It can apply to a purchase, rate and term, or cash out refinance. There's your rate ranges, minimum credit scores. I've seen us get around stuff like this in the past. Depending on a variety of variables, you may not need this minimum. If the rest of, there's compensating factors and the rest of the scenario is very strong, you may not need that experience. Anything here, Carly? I don't know. Is that for me? No.
Oh, I just started the poll. So go ahead and
thanks.
answer
I'll
there
minimize
for
it.
ground up
Okay.
construction. Yes.
Thanks, honey. It has to be in a US entity. We don't want to be in rural markets, and it's got to be shovel ready. So what that means is that it can't be raw land. Okay, so it's got to be improved. plans and permits. Everything's got to be all ready to go. The county has to have signed off on everything, etc. So yeah, that's that. We're going to be adding some other portfolio products too, just expanding some of our bridge loans and maybe our debt service ratio. I don't think that we had announced this. It's fairly new too. We recently removed our non-recourse. So as of today at 2:01 p.m. the 25th, we are not offering non-recourse on any of our cross collateralization, which was the only place that it lived before anyway, for a few reasons. One, non-recourse comes with very, very harsh prepayment penalties, and we know that people are going to be refinancing more likely than not in the coming years, so it didn't make sense. And two, for reasons that I described earlier, the non-recourse terms are so much worse than the recourse with a personal guarantee, and it just didn't make sense. So anybody that was interested in that, no, for the moment, we're not offering non-recourse. That was the only product that we had it for, and we're not giving it on that anymore. So yay. Oh, I have something else to share with you. I have also been actively pursuing a self-directed IRA expert that we are going to have on one of our coming up Tuesdays. And then a portfolio partner is going to come on and start talking in more detail about some of the ground up and debt service and bridge loans that we're going to be bringing on soon as well. So be looking for those announcements. Anybody else before we wrap for today?
Yeah, we do have a question from Maru. They ask, can we use a loan to add on an ADU?
The ground up construction, yes, absolutely. Madhu, you can do that. Yes. So anybody that's interested in adding, whether it's a purchase or you own the property and you're refinancing to add the ADU, absolutely, that works.
Perfect. So I'm going to go ahead and end this poll and then share the results with all of you guys. So you can go ahead and check those out.
Oh, look at you guys. Okay. So yeah, so it looks like you guys, there's a significant amount of you that are interested in ground up. That's exciting. So probably the best case scenario is just to email me or info. Just email info because I'm on the distribution. I'll see it with your circumstances, and then we can kind of give you an idea of expectation. If you've never done one of these before, that's okay. Well, you need to have some history of investing. We'll talk about that. I don't want to go down that rabbit hole. Just let us know what your scenario is, and we'll get on the phone and hash it out.
Perfect.
Okay, guys. Yeah, go, Carly.
Oh, sorry. I do have one more question, then we can go ahead and end it. But Ginny asks, is there a reason a DSCR loan would need to go into my personal name instead of my LLC?
It's going to be about terms, Ginny. So you can choose. If you really, really, really don't want it to be in your personal name, fine. But you're going to expect that the terms are going to be less favorable if we close in the entity name. And keep in mind, you're going to have a personal guarantee on it anyway. So looking at those side by side and weighing the options, you may decide that it makes more sense to go ahead and close it in your personal name, close in the entity name, or quit claim into the entity name. Because at the end of the day, you guys, it shakes out to be the same liability. So if the entity, if the LLC, let's determine what is the need. If the need is exclusively asset protection, my advice is to, if you have golden tickets left and you qualify, use the golden ticket. If the LLC need is for asset protection only, that is your best possible scenario. If it's available to you and you qualify, right? If you have golden tickets left and you qualify, use that, transfer it, quit claim or warranty, some states call it a warranty deed, into the LLC for that asset protection. Because the other scenarios that either let you close in the name of the LLC, right? Whatever combination thereof is, at least with us right now, and 99% of the other loans that you're going to find out there will have that personal guarantee. So from a liability standpoint, from that perspective, it's the same. There is no difference. You're personally obligated to that debt, and you've signed a personal guarantee so that in the event of default, they do legally have the right to come after you personally, though I've never seen it happen that way. The non-recourse, no personal guarantee is the only way around that, and your terms are going to be far less favorable. Hopefully I answered your question, Jenny. If I didn't, feel free to hit me up an email if you want.
Perfect. We have
Okay.
one more from Jamal. Can those loans work to buy and put in boxables?
Jamal, I don't know what boxables are. Tell me what that means.
They're tiny homes that are pre-built. The
Oh,
US government, federal government, and Elon Musk have bought tons, and they're about $50,000. They're nice, and as long as you have a slab and all the utilities. they fit on that.
you're breaking up just a little bit, Jamal. I'm going to say that it's possible. Why don't you email me and I'll double check
Yeah.
with our investor.
Okay, great.
We're selling
Thank you.
to. Yeah, you bet. Thanks for the question.
Excellent. Thanks.
Is there another one from Jeannie? I opened up our meeting. So real quickly, Jeannie, for tax reasons, this brings up a good point. No, there shouldn't be any difference. And let's be clear about something. So you'll have an option to file if you've personally obligated the debt anyway, which is what you're going to do. Like I said, now 50 times, filing it on a business tax return is only going to hurt your chances of going conventional again later anyway. Because the rules conventionally say that if you have filed your residential investment properties on a business return, on the LLC return, but you personally obligated the debt, you will not get to take any of the gain from whatever the Schedule E calculation comes out to be, but I will hit you for the loss up to a maximum of the property's PITI. That's a little convoluted. I would say ping me on that, Ginny, and I will go over it with you. I think it requires some visual aid just to kind of show you what I'm talking about, but there isn't going to be any difference between now. If you're a corporation and you're starting to have K1s, et cetera, that's another conversation. But if it's just a straight LLC, no, there's not going to be any difference in the taxable benefits that you would receive from one or the other. But there would be a very significant difference in how you would qualify if you do it the way I think you're defining. Okay, team. So I'm going to try, Jesus, I'm going to try to get my shit together, excuse me, and make sure that next Tuesday, I've got the amortization and the interest only visual aids ready for us to dig into that. So say a prayer for me, please. Otherwise, we'll have some other good content to share with you. Okay, guess what? We're on standby. If anybody needs us for anything, you know how to get us. ridgelendinggroup.com, info@ridgelendinggroup, 855-74-RIDGE. All of those things. See you soon. Bye, peeps.